Hello, I'm Peter Herbert and welcome to this month's short CPD webinar looking at practical aspects of accounting and auditing. Well, it's September, school's back and minds turn to education. And we of course have academy trusts that have all got 31st of August year ends, FE and HE colleges that have all got 31st of July year ends, and their accounts need to be submitted by the end of the calendar year. So a very busy time during the autumn for auditors of academies and FE and HE colleges. And what we thought we'd therefore do today is have a roundup of what's new in these areas from an accounting and audit point of view, and also give you a heads up as to a few things to look out for when you are doing those audits over the coming months. So here's our coverage. We're going to begin with a regulatory update in respect of academies. We'll then look at some academy hot topics and then finish off with some other considerations specifically for auditors of FE and HE colleges. Okay, let's begin then with our Academy's regulatory update. So I suppose we always think that whether it's academies or indeed FE, HE colleges, it is really, I guess, a techie's dream from a regulation point of view. Lots of different regulations all underpinning the preparation of academy accounts. What, of course, gets updated annually is the Academy Accounts Direction and the Academy Trust Handbook, and we'll talk about both those over the next few minutes. I think from my mind, though, based on the queries that I get about the accounting for academies, lots of the answers I provide do tend to lean quite heavily on the charity SORB. I think the charity SORB is a very key source of reference when it comes to the accounting challenges that academies do face on a day-to-day basis. But it's the accounts direction that gets updated annually. And as I say, we'll drill down on that in the next couple of minutes. There's our reporting timetable for 23-24. One or two aspects of that was slightly delayed with the election in July, but it looks much as it normally does like this. We've got our key deadline for submission of the financial statements, as I've already alluded to, being 31 December. And that, of course, is going to be the deadline for submission of the accounts, the audit reports, the reporting accountant's report on regularity, the management letter, and also the summary of the output of the internal scrutiny, which has been done over the course of the year. So lots of submissions for academies at the end of the calendar year. And then 28th of Jan 25 is the deadline for the submission of the accounts return, which of course informs the national consolidation of Academy and Trust accounts into the sector annual report and accounts, or the SARA. In terms of the accounts direction for 23-24, as has been the case for a couple of years now, there are different elements to that. There's the main accounts direction, there's the model accounts, the Coketown model accounts, which I think are a brilliant point of reference for preparers and auditors of academies, and also the guide for auditors and reporting accountants. So the elements the same as they've been the last couple of years. Now, in terms of the accounts direction itself, I think the sector now is reasonably mature, and therefore I think that year on year, nothing massive tends to change in terms of accounts direction. As I'm sure you'll be aware if you work within the sector, what they do annually is to give people real clarity at the front of the document about what things have indeed changed. That's a summary really on the slide there. Let me quickly just run through perhaps a couple of aspects there which are worthy of a little bit more detailed consideration. So first of all, the internal scrutiny process, which the trust must undertake on an annual basis, does specifically now need to include a review of governance. And not only is that a requirement in terms of what internal scrutiny needs to deal with, but that also needs to be dealt with and commented on specifically in the governance statement within the annual report. So the governance statement will evolve slightly. And what they're saying there is be careful of just rolling forward that governance statement. The scope of the review might be slightly greater with this new requirement, and that will therefore impinge on the way the governance statement is presented as a result as well. The SFA produce really good feedback annually on compliance, so areas that they've challenged trusts on from the review work that they do. areas where perhaps auditors, reporting accountants maybe have modified their opinions. So do have a look at that really helpful feedback. It's all accessible on gov.uk. Very good food for thought there for people working within the sector. Very good food for thought there as well, I would say, for those that are doing audits as well. And to me, probably the most helpful and interesting aspect of this year's accounts direction is clarification with the determination of the value for the initial recognition of long leasehold premises. And we'll have a look at that in a little bit more detail on the next slide. Now, that's basically the paragraph that's been introduced. And I think whether you're working within the sector or whether you're an auditor, it can be a challenge. I guess when you've got maybe a grant maintained school converting to an academy, or perhaps a single academy trust transferring across to a multi-academy trust, when you bring long leasehold property across, what you've got to do is use fair value. And I think we do find people are sometimes somewhat scratching their heads in terms of working out how that fair value would be determined. And what paragraph 3.27 does now, it provides some good practical tips on different ways that fair value can indeed be determined. The bit that I think is quite interesting actually here, though, is sub-paragraphs 5 and 6 there within paragraph 3.27. And that comments it comments above there, doesn't it, that as explained below, now items 5 and 6 are not options in their own right, but they can be used for comparative purposes. So valuation certificates provided by the DFE is not in its own right the basis for evaluation, because they're prepared under international financial reporting standards, and neither would insurance valuations be appropriate either. That, I think, is quite helpful clarification. Now, we do find situations where audit firms happen across valuation certificates provided by the DFE for existing established trusts where long leasehold premises has been transferred in quite a while ago, and where those valuation certificates indicate a fair value lower than the current carrying value. I think audit firms do then have concerns that the assets concerned should be impaired off the back of the valuation certificate being provided. What we would always say, and this I think probably underpins that, is where that valuation certificate that maybe has fallen into your lap indicates a fair value lower than the current carrying value. Now, that might prompt some conversations about impairment, but that would not in itself necessarily be a trigger for an impairment write-down. A common question we get asked around that, and that I thought would be helpful to clarify as well. Okay, so that's the Academy Trust accounts direction, and then the Academy Trust handbook, also relevant, isn't it, to the work that auditors, accountants would actually undertake. I guess in terms of the current season for the Academy audits, 2 handbooks to sort of be across. The 23-24 handbook, which I guess will inform, for example, the regularity reviews that you will do at the current time. I guess from the point of view of the trust itself, this is very much kind of old news now, because they're very much more focused on the second of the 2 handbooks currently in circulation, which is the one that applies from 1 September 24 for the next financial year. So I guess just being mindful of what's in each handbook. And I guess, yeah, from a regularity review point of view, you are still very much focused on this handbook. Looking forward, we've got the 24-25 handbook, and that is still, fairly relatively hot off the press, and brings in a couple of quite interesting developments, as we'll see in the next few minutes. Now, as with the accounts direction, nothing massively impactful here on this slide in terms of the 23-24 handbook. I guess the one thing we were talking about a lot on last year's courses, picking up on the second point there on the slide, emphasising the importance of good estates management. There was a lot of focus, wasn't there, last year on the impact of RAC, reinforced autoclave aerated concrete, where you've got school buildings which have been constructed using RAC that were now in a state of disrepair. There's important operational considerations there from a trust point of view, and from an accounting point of view, potentially impairment considerations as well. I think it's important that trusts and their auditors are still alive to that, and that I think is very much reinforced by the handbook being clear of the importance of good estates management. I guess the most impactful thing in the 23-24 handbook is a slight change to the requirement around the need for ESFA approval for related party transactions. Now, remember the way it works, that all related party transactions that a trust enters into must be communicated to the ESFA in advance. This, I think, makes it a real challenge to have related party transactions going on at all in this particular sector. And that, to my mind, means that for many trusts, they just don't go there. It's too much burden, too much process in order for a related party transaction to be entered into at all. Furthermore, the way it's been until now has been that when you've got a situation where you've got a supply agreement whereby a related party supplies goods and services to a trust, and where the contract value exceeds 20,000, that transaction would not only need to be communicated to the ESFA, but you'd need prior ESFA approval. Now, what's changing here is the threshold for approval doubles at a stroke to 40,000. Possibly impactful for some situations, but going back to the point I mentioned a moment ago, I guess for so many trusts, related party transactions are pretty much few and far between these days, and therefore perhaps doubling the threshold for approval maybe isn't quite as impactful as we might think. What I get a sense of is that the point here about simplifying arrangements for RPT with other educational providers that are also related parties, that I think is really helpful and a good development. So that one I think probably is the one to be alive to. That I think is helpful. The reduction of the threshold for approval for other transactions or the increase, I should say, from 20 to 40k may in reality not be quite as impactful as you might think. All relevant for, effectively 31st of August 24 year ends. And finally, in terms of the 23-24 handbook, they produced a sort of a quite helpful Excel-based schedule of musts that can inform the accounting officer's conclusion on regularity. That obviously is very helpful from a trust point of view. It is an optional resource. There's no requirement to submit that to the ESFA. But again, I guess what I always get a sense of is that where an academy breaches one of the musts in the academy trust handbook, that might trigger you as a reporting accountant to modify your opinion on regularity. And that schedule, I would therefore say from your side, is quite good to have in your kit bag, as well as it being in the kit bag of the accounting officer. So those are the sorts of the key things to be alive to in terms of the 23-24 year-end audits. Let's have a very quick look, if we could, at the 24-25 handbook that takes effect from 1 September. And I guess the key thing that changes here, and again, as with the accounts direction, the handbook makes really clear what's changing year on year, but the really key change here that's been well trailed, I think, in the accounting press over the last few months is the fact that finance leases no longer need approval. And that is very much front and central here within the new Academy Trust Handbook. Now, this has been a really sticky area, hasn't it, over the years? Because what we always say from an Academy Trust point of view is whenever it borrows, that borrowing requires prior ESFA approval. Not to seek that approval would very much be a breach of one of the musts in the Academy Trust Handbook, and that would then likely trigger a reporting accountant to modify their opinion on regularity. The change here in no way, shape or form yet impact on the accounting for leases. So from a UK GAAP point of view for the next couple of years at least, the operating lease finance lease distinction still very much prevails. But what's changing here is the regime around what leases would require approval. And they're moving away from a world whereby finance leases, which is substance of borrowing, do need prior approval, and operating leases don't need prior approval, to a world whereby leases of certain assets will and leases of certain assets won't. And I think for a lot of people working within the sector and for their auditors, that is a very, very helpful development indeed. Now, there's a link to the guide there on the slide. It's been around this guidance since March. It only comes in with effect from 1 September as we now have the new handbook coming in. that essentially is the list of assets where, if leased, you would not need to get prior ESFA approval. Any other asset, you would. Okay, so that's just a bit run through some of the regulatory changes for 23-24 year end. Let's move on, if we could now, and have a look at a couple of hot topics relevant to Academy Trust audits. Now, again, one that's had a few column inches in the accounting press of late has been some movement in the holiday pay accrual saga linked to the Harper v. Brazel case. This, I think, is very much relevant to FE and AG colleges in the same way that it's relevant to Academy Trusts as well. And this goes back to 2022 and a Supreme Court ruling regarding part-year, term time only employees. And yeah, the way I guess it works is that if you're a full-time, full-year employee, you're going to be entitled to 5.6 weeks of holiday pay. What I think a lot of trusts would have done for term time only workers would be to say, right, we're going to take 5.6 weeks, divide that by 46.4 weeks, that's the full 52, minus the 5.6, that gives us a percentage of 12.07, and we'll apply that 12.07% to the remuneration in the weeks in the year that they work, which will be the part year. And that will therefore mean that for a part year worker, the entitlement was lower than for a full year worker. Part year workers protested. There was this landmark case in the Supreme Court. The Supreme Court ruling decreed in favour of the part year workers. And what I think trusts have been doing ever since is saying, right, we've got to now be at least alive to the idea that we need to provide the full 5.6 weeks to those individuals. And that might mean the holiday pay accrual increases as a result. Now, that's not a particularly new issue, but what's changed is governmental legislation in the form of the working time regulations, which means that a reversion to a percentage method will be appropriate. And therefore, I guess going forward, what trusts need to think about is the need to actually revise down the holiday pay accrual based on the new working time regulations. Now, it may not always be material. It may not therefore always be a massively big issue for trusts. The sense I get talking to audit firms is that trusts are actually generally all over this. But I guess what's also important to be aware of here is that this new regulation applies to leave years beginning on or after 1 April 24. That will therefore likely be 1 September 24. If there is going to be therefore some sort of rebalancing of the accrual off the back of the regulations, that might more likely impact from next year compared to this, but at least having a conversation during the course of this year's audits would be no bad thing to do. The second hot topic, and again, it's been around for a while. Again, it applies to HE and FE colleges in the same way that it applies to academy trusts, is the determination of defined benefit pension scheme balances. Of course, historically, pension scheme balances in the books of academy trusts and so many other organisations with defined benefit schemes, albeit multi-employer schemes, has tended to be a liability balance. Because when you take the fair value of scheme assets and then you take the net present value of scheme liabilities, obligations to make payments to scheme members going forward, discounted back to net present value using yield on high quality corporate bond, that would normally leave you with a net deficit position and therefore an overall liability. The last couple of years, with interest rates being high, that's meant that yield on high quality corporate bonds have been high, and that's therefore left us with very often a net asset position. And the million-dollar question is, can that asset position be recognised on the employer's balance sheet? And what FRS 102 says in paragraph 28.22 is that you can recognise that asset only to the extent that it can be recovered through reduced contributions in the future or through refunds from the plan. Now, my observation, and it's not a recommendation, but an observation, just based on talking to lots of those about this, is that generally speaking, I would say these asset positions have not been recognised. Now, I think academies, FE colleges, HE colleges, and their auditors are generally taking a fairly prudent view on the approach. You can obtain through the actuary what we refer to as an asset ceiling report that would inform the asset that could be recognised potentially under paragraph 28.22. But because I think so many trusts have taken the view not to recognise the asset, probably based to a point on good old-fashioned prudence, I've talked to quite a few firms over the last few months where their clients haven't even sought out the asset ceiling report because they don't want to spend the money because the asset will just not get recognised in any case anyway. So observations, I suppose, 12 months on is still an issue, but paragraph 28.22, yeah, it's a very live paragraph because at the current time, with interest rates being high, we are getting these asset positions materialising more often than they would have perhaps 3 or 4 years ago. Ultimately, it's the client's decision whether the asset gets recognised. It is a key judgment. And as the FRC keep emphasising a lot of the messaging that they provide in terms of corporate reporting generally, if you do, form a judgment and take a view on these matters where they're material, do tell the story in the notes to the financial statements. Right, let's finish off with some issues for FE and HE college auditors. First, worth remembering that the principles of accounting for HE and FE is similar to what it is for academies. But of course, HE and FE colleges, they defer to the HE and FE college SORP, where academy trusts, they will defer to the charity SORP. And one big difference there, I think, is the rules around income recognition, particularly in relation to grants. So they are quite similar, but remember, there are different SORPs. And in that regard, you've got to be mindful to the fact that the rules differ. The charity SORP is always pushing, isn't it, from a government grants point of view towards the performance method when accounting for government grants. What the HE and FE college SORP says is when you've got a grant for land, use the performance method, but when you've got a grant for anything else, a government grant for anything else, you can choose performance or you can choose accruals model. Remember that for HE and FE colleges, again, a really wonderful resource, which is the Casterbridge example accounts, published by the Association of Colleges. Again, a very useful resource. I think from a file review point of view, we do generally find relatively few problems with Academy Trust annual accounts and with FE and HE colleges annual accounts, because the Casterbridge accounts are brilliant and the Cokedown accounts are brilliant to getting you over the line and making sure that there are no glaring errors. All free resource, that one, of course, from the Association of Colleges. Big change affecting HE and FE last year was reclassification. They were reclassified within the public sector, and that therefore means more regulation for HE and FE with effect from, November 22. Less delegated authorities, more things require approval from the ESFA, much along the same lines that you've got with academies. And one big area where there's been quite significant change there has been the need for prior approval of new loans since the date that reclassification came in. That was impactful, I think, from a regularity testing point of view for July 23 year ends, and that will roll forward and impact also on regularity testing in 24 year ends as well. Linked to that, we've now got a financial handbook for FE and HE in a similar sort of way to what we've got for academies, not quite as in-depth, but we've got a similar sort of feel there with a handbook for FE and HE that we got for academies. That's effective from 1 August 24, effectively therefore for the next financial year. But again, if you do have clients in that sector, that's something they need to be aware of moving into next year. And I guess as we get more alignment of academy and HE/FE, that I guess will mean that the regularity review will be similar, but not identical, whichever type of organisation you're providing a reportance account on. I think what lots of HE and FE college auditors tend to do from a regularity testing point of view they use as a start point the self-assessment checklist used by the accounting officer to inform their conclusion on regularity, and they go from there in terms of the review that they do as well. Okay, so there we are. We've had a look at some of the new changes from a regulation point of view for academies, quite a few of those impacting for 23-24 year ends, and therefore very relevant for the audits you'll be doing at the current time. One or two of those impacting going forward in the 24-25 year end, and therefore one certainly to make sure that clients are across. Talked about a couple of hot topics that, although they were framed more in the context of academies, are relevant very much to FE and HE as well. And then right at the end there, a few specific issues relevant to the auditors of HE and FE colleges. Hope that was useful. Remember, do have a look at our website, www.insight-train.co.uk for our full list of programme courses for the autumn of 24. And I look forward to speaking to you again on another webinar very soon. Thank you.